Yeah, so it all comes down to who's going to manage it. So I just invested in a real estate syndication that's focusing on senior housing.
Mm.
My partner and some of my other real estate deals is sponsoring that deal, and I asked, three questions. I said, "How much money do you need? Who's going to manage it? And will I ever have to go there?" He said, "I need $50,000. We're hiring a expert property manager in that area
Mm.
that has experience on this exact thing, and
Mhm.
you will never have to go there." And I said, "Boom, sold." Here's my $50,000. And that's because I trust him as a sponsor, 100%.
Yeah.
Now, is this deal going to be a grand slam? I have no idea, but I trust that he will do the right thing to make sure that the investors are taken care of in the best possible way. So I didn't even, you know, fly to Florida, like tour the building, like I didn't do any of that stuff. I just invested in real estate syndication like that. So I'm an LP in that deal.
You're listening to the Accredited Investors Only podcast presented by Accredited Life.
All right, Stewart, welcome to the show. How are you feeling today?
Doing great. Thanks for having me.
Oh, thanks for being here. So, why don't we start with you introducing yourself? I'd love to hear you introduce yourself in your own words to the audience.
Okay, great. My name is Stewart Beal with Beal Properties and Beal Capital. I started investing in real estate when I was 19, 22 years ago. I've completed more than 600 real estate transactions on the buy side and selling side. And we currently manage about 2,000 apartments, 100 commercial spaces in Southeast Michigan and Toledo, Ohio. And we do real estate syndications, and we're launching a new fund in January.
Awesome. Great. Well, there's a lot to unpack there. Let's start with, 19 years old, getting into real estate. What was the catalyst for that?
Yeah, okay, great. So this was in the mid 90s. Take it back to the mid 90s. I was, 12, 13 years old. And my father subscribed to about five different business magazines. And when they were done kicking around his office, he would bring them home, and I would read them cover to cover every single month for
Nice.
five years. And I tell people it was the mid 90s because then they realized that this was before the internet.com boom. This was before crypto. This was before a lot of the flashy things that you read about these days. And so in those business magazines, there were two routes to wealth. The first one was to build a great company, and the second one was to invest in real estate. So that's kind of how I got exposed to real estate. When I was 13, I started my first company, a lawn mowing company, like many people do, mowing your neighbor's lawns. But when I was 16, I got really serious about it, made it an official company. And then when I was 19, I sold that business for $250,000.
Wow.
I got $50,000 down and a note from I lent the buyer 200,000 to buy the business. So it was about 1,500 a month for 10 years. And so I had the 50,000 and I had that security of 1,500 a month. And so I made my first real estate investment. I bought a 5 unit apartment house in Ypsilanti, Michigan, directly across the street from the Eastern Michigan University Business School.
Mm.
And I did a what they call a house hack, where I lived in one of the units and rented out the other four. And that's how I got started in real estate.
Nice, nice. We have something in common there. My first purchase was a duplex where I lived
Okay.
in one of the units, and I got an FHA loan, so it was super. I think I might have been out of pocket like $3,500, something like that. And it's a good way to get started. That was my kind of introduction. So talk to me about where the journey took you from there. Obviously, 600 plus transactions later, it's evolved a lot. So let's hear kind of how it's evolved over the years.
Yeah. Okay. Great. So the purchase was in 2002. I was 19, and I purchased a property a year for the first couple of years. So I bought that 5 unit, and then I bought a rundown downtown building that I developed into a retail space and a couple of loft apartments. Then I bought another like 4-unit, and then the next year another 5-unit, and then I bought a 30-unit. That was a big step up. And that was when I decided that I wanted to focus on real estate primarily instead of building, some big great company.
Mm.
And so uh, another property, and then the foreclosure crisis hit. And in Ypsilanti, Michigan, where I live, the foreclosure crisis lasted 6 years, if you can believe that. So it got bad in 2008, and it didn't really recover all the way until 2014. So um, I bought I went from buying a property a year to buying a property a month in the foreclosure crisis, and I bought 50 properties around Eastern Michigan University in Ypsilanti, uh, because I think 3 landlords lost 75 properties to the bank. So in the span of 3 years, 75 apartment houses came on the market, and I bought 50 of them. Um, and I was able to recycle the capital over and over again. I would buy a property with cash. I would fix it up with cash. I would do a cash out refinance and then do the same thing over and over again. Um, and I partnered up with some banks who let me do it 20 times in a row on the same loan,
Nice.
kind of like a line of credit sort of thing. And that's how I quickly started doing more transactions than just the one a year.
Wow. And talk to me about the transactions. So were you finding the properties? Were you kind of GCing it yourself? Were you property managing it, or what did your team look like at that time?
Yeah. So I immediately realized it was a once in a lifetime opportunity in the foreclosure crisis, because I compared the cost of what the properties could be purchased for versus the cost of what it would cost to construct them. And a lot of people were bailing on their real estate and didn't understand that things go up and things go down,
Sure.
and they didn't realize what was happening. And I somehow just knew that this was a once in a life opportunity, that this was like a rock bottom period, and it's going to go shooting up again in the future because of construction costs.
Sure.
In decent areas, properties should trade for what they cost to build them. At a minimum.
Yeah, right.
And so in my area, which I considered a decent area, they were going for 10% of what it would cost to build them. So I just scooped them up.
Hmm. Gotcha. And so from a management perspective, were you the property manager? Like and I'm assuming you're running these mostly to college students, or what did that look like? And then were they
Yeah.
calling you and you were doing all that, or?
Yeah. Okay. So I'm very actively involved to this day in my business. And back then, I was running a construction company that had about 100 employees, and also running the real estate company. So, but there was a lot of crossover,
Sure.
So we would buy a property and then we would hire our own construction company and that sort of thing. But yeah, I was the sole property manager for um way too long, and I was able to go way too long because I hired very good help. I hired a leasing agent, I hired a maintenance manager. So now I'm no longer going to the properties every day. I can sit in an office and get things organized because the leasing agent's the one going to the properties. So it kind of just progressed from me being the first employee back in 2002 to today. We have 50 employees and 14 virtual assistants working in our business.
Yeah, I think that's a very important fact for people to understand that are looking to get into the space, or for a passive, yeah, on the active side, or for a passive investor who's analyzing a team or something like that. A lot of times I get questions from investors is like, how are you managing, that many properties at scale? And, and isn't that a lot of your time? Or, oh, doesn't that suck to be managing those tenants and properties and that kind of thing? And it's like, well, I'm more managing the managers than I am, dealing directly with tenants and things like that. So I think a lot of people don't realize that. They think they need to wear all the hats, but it's in a lot of times, especially as you get larger, that's actually a detriment if you're wearing all the hats. You become a bottleneck at that point. So it's really important to be able to leverage the expertise of others and bring good people on. So let's kind of fast forward to today. What does you mentioned, having 50 employees, the virtual assistants. What does the business look like today? What do you guys, because I'm assuming, you're not picking up properties at the discounts maybe you were back in those days and all. So what are you buying now? Let's talk about that.
Yeah, so in 2014, I started doing real estate syndications. I've now done 9 of them, and then I've also invested in 3 or 4 of other people's syndications, close partners of mine that did their own syndications. So from 2014 to 2020, me and 4 partners raised $130 million from investors, and we purchased approximately 130 apartment complexes. Um, in 2020, when COVID set in, we realized that we probably shouldn't be taking on more debt and buying more properties. And the partnership frayed just a little bit, not in a negative way, but just like, okay, this group worked really great for 5-6 years, but this isn't going to last forever. So what we decided to do is we decided to sell all 130 of those apartment complexes. That took 2 years, from 2020 to 2022. We did it at the exact right time. Interest rates were very low, and so we were able to command premium prices for some of the properties.
Sure.
And then I decided that I wanted to keep doing real estate syndications, but I didn't want to have partners. So in 2020, I started my own. It's called Beal Capital, and on January 1st, we're going to launch our 4th fund for Beal Capital. And what we're targeting is Class B apartment buildings in Southeast Michigan. And I'm actually launching 2 funds. One's going to be for apartments, and then one's going to be for commercial, medical, office space, strip centers, retail buildings, things like that. I've had some really good success recently with that type of model. So that's what I'm looking for. And so, like, next Friday, I'm buying 4 properties in one day. I'm buying a 15,000 square foot medical office building. I'm buying a 6-unit apartment house in a strategic location, and I'm buying a 2-unit retail building where there's going to be it's 2,300 square feet and 2,300 square feet, and then I'm buying a 3,000 square foot 2-building cafe type spot next to another building that I own. So we really like commercial, as long as you can figure out the leasing aspect.
Sure.
Obviously, I don't want to be sitting on large swaths of vacant commercial space, but if we can figure out a strategic way to lease them, I really like commercial, because as the property manager, we own the property management company. As the property management is a lot easier in commercial, and it's a lot less mentally abusive in commercial.
Yeah, my dad was a commercial property manager, and he loved it. I mean, it's funny how some people hate the management side of the business and all, but he absolutely loved it, and it has a lot of funny stories there. But let's rewind a little bit. So let's go back to like the syndication business. I like to just see the evolution of that. Now, were they all individual syndications, or did you ever do a fund for that? Or you said 130 properties. Were they all individually syndicated, or was that through different funds, or what would that look like?
Yeah, all 9 syndications that I've done are blind pools of properties. So what you do,
But before your stuff, even the past partnership, were they all the 130 properties you mentioned? Were they all individually syndicated, or were they in funds, or what did that look like?
yeah, so it happened progressively. So the first thing I did is we were coming out of the foreclosure crisis. There were a lot of good deals. I ran out of cash because my model of cash out refinances stopped working. And so I was like, okay, all my equity's trapped in the deals I've already done. How am I going to get new money to buy properties? So what I did is I formed an LLC called 317 eCourse LLC. I put 317 eCourse under contract, and I asked 3 friends to each invest 25 grand into the entity. I put in 25 grand into the entity. So now you've got 100 grand in the entity, and then we did a land contract with the seller and bought a 14 unit strip center. So that was like the first investor thing that I did.
Yeah.
It wasn't a syndication. It was just a simple operating agreement. We're all true partners.
Yeah.
There's no GP, no LP. There's just I didn't know about it.
Sure.
Once that was done, 3 of the 4 of us in that deal decided to start a real estate syndication business. We raised $2.6 million from family and friends, $25,000 at a time, and we bought 14 apartment buildings with it in Southeast Michigan and Toledo, Ohio. My company managed all of them because we were capable of onboarding 14 properties. But then one of the investors, or 2 of the investors in that first fund, said, wow, like, we really like this. We want to help you do this more seriously. So they came, and that's why we had a partnership of 5, and we raised $5 million, and then we raised $10 million, and then we raised $20 million, and then we raised $50 million. And so, or maybe it was 2.6, 5, 20, and 50. So then those were 4 separate funds, and they never overlapped. So you open a fund, you take in the investors, you deploy the capital, you close the fund. And then we just repeated that 4 times, but just higher dollar amounts.
Sure.
And so by the time we got to the 4th fund, we were dealing with some more serious money. We couldn't buy the small properties that I'm used to buying over my previous career. So now we were targeting really big properties. So the largest property we bought was a 468 unit apartment complex.
Gotcha.
Yeah.
Talking about the process of raising, getting those larger raises, especially at that time, because I'm sure, social media, raising money online, social media back then wasn't even around, right? It was, or if it started to be at its infancy. What did that look like? How are you able to continue to raise more and more and more and meet those investors and get them to invest?
Yeah. So we had a multifaceted strategy. The first was family and friends, and then doing pretty good with them. So they start introducing you to their family and friends, and then they introduce you to their family and friends, and it kind of expands like that. We also use crowdstreet.com to raise $10 million. So we did raise money online like that. We also hired people in the capital introduction industry. You pay them anywhere from 1.5% to 4% of the money that they raise for you.
Sure.
And we also did events, a lot of events actually. Every couple of months, I was traveling to Texas or Georgia or New York, and then we would also invite investors to come to see us. My office is 20 minutes from the Detroit Metro Airport, so it's really convenient for someone anywhere in the country to come fly and see what we're doing. And so that's how we raise the money. But the key to the real key to raising the serious money is having a team member who does it full time and only does that one aspect of the business. You're not going to be able to raise serious money being the property manager and the acquisition guy and the loan guy and the accounting guy and the guy in charge of insurance. And you're just not going to be able to raise serious money. So I don't have this figure exactly dialed in, but we raised money from 984 people over that period. And I think my partner, Tom, probably did 10,000 1-hour phone calls, over that period to get that,
Yeah, sure.
I mean, I would look at his calendar and he would pull me into some of these calls a lot of the time. And he would just have hard stops like, okay, investor, we just talked for an hour. It was awesome. I've got another call, and just boom, 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 boom. And how did he meet those people? It's all just constant networking and like, hey, do you know anyone who might be interested in investing? And, and if you're doing this in a small town like I am, I live in Ypsilanti, Michigan. There's 22,000 people that live in Ypsilanti. We didn't take a single dollar from anyone who lives in my city. The key is getting out of your bubble and into where, the serious money is. And that's New York, that's Atlanta, that's Dallas and Houston and things like that. and that takes a lot of work, a lot of work,
Sure.
because you're not going to raise, $250,000 from your friend that lives in the same city as you very often.
Sure.
Um,
So that's a very difficult strategy to scale if you're just doing that, right?
right. So that's the key, is like having someone do it full time.
Yeah.
And so we had 5 partners, and we each had like a little bit of the business.
Mhm.
So Tom was the one doing the fundraising. I was the one primary doing the acquisitions, and
Mhm.
that's how that worked.
Yeah, I think that's a great way to explain it. Very good information and insight for any of the listeners, whether they're looking to get active or looking due diligencing passive opportunities. All the insights you're giving here are good questions to be asking operators and their teams and how they operate and how what their team looks like and the makeup and all that kind of stuff. And as I do a lot of fundraising, for our projects and things like that, and it's a grind, like you said, and it's only really become harder over the last few years with things going on in the market, and then just
Much
with
harder now.
yeah, right. I mean, with social media is, now it's like you can practically take a weekend course and be a fund manager and raise money for other people's deals. So there's a lot more fish in the sea chasing the same kind of money and stuff like that. So what would you say? What are the big differences between managing the smaller properties, 10, 50, 60 doors, something like that, versus like the 400 unit properties? And then what do you focus on now? You mentioned one of the properties you're closing next week was a apartment home, 6 units. But it sounds like that was like a strategic purchase. Are you focusing on the larger stuff now? Are you focused on the smaller stuff? And then speak to me of the difference and kind of why, and just I'd like to hear your mindset around that.
Yeah. So lots to unpack there.
If it is, I have a
Yeah.
knack for asking questions that are probably too big. I could chunk them up into three, but go.
Right.
I won't forget the questions, so just go. And if I'll ask you if I need more info from you.
Yeah. Okay. So first of all, there's a huge difference between managing the smaller properties, what I called scattered site property management, and the larger properties. Okay. The
Mhm.
first thing is the quality of the staff. Okay.
Mhm.
So if you own a large apartment complex, you're going to be able to attract higher quality staff to work for you than if you are managing scattered site. No one wants to be running around in the freezing cold, driving to 10 different properties and having to know, 20 different furnace types, and every single building's got a different furnace filter and boilers work different. And, it's just way easier to manage larger properties. The 468 unit property, that was a dream. We had 7 full-time staff members that all they did was take care of that property. We could pay the property manager an above average fee or salary because the property was so robust. We could pay a full-time maintenance manager, two leasing agents, 2 laborers, 2 maintenance guys, 3 maintenance guys, something like that. And they knew what they were doing every single day. As the owner of the property management company, I didn't have to tell them what to do every day. On scattered site, what I manage mostly right now is scattered site, smaller properties, 10 units, 20 units, 30 units. I have to spend an hour every day telling what 50 people are going to do tomorrow.
Sure.
Because it's all different properties all the time. Turn this apartment that's 20 miles, and then when you're done with that, turn this one another 20 miles away. It's a lot more difficult.
Yeah.
Now, of course, it's a lot harder to buy larger properties for many different reasons, of course, mostly capital reasons. And so, you're going to get into smaller deals all the time if you're trying to do this, and you're going to try to get systems that work for you to manage them. What I'm targeting now is 15 to 25,000 square foot commercial 1-story office buildings that I can chop up and rent to schools, gyms, medical facilities, retail, restaurant, cafe. And then if I'm lucky enough to find an office user, sure, I'll rent to an office user. That's what I'm looking for, 15 to 25,000 square feet. That's pretty robust for me. And then I own a scattered site property management company, so I'm not afraid of smaller deals. And so I'm looking for like 30 to 150 unit properties. But I did bid on a 1,100 unit property last month. It's about 7-8 miles from my office. And if we had gotten, we were off by a little bit, but if we had gotten that into contract, we would have gone to New York and raised serious equity from like a equity broker.
Mhm. Yeah. Wow. So the let's talk about the commercial side of the business. Yeah, I mean, I've spent time in commercial brokerage and leasing and sales of all kinds of different commercial, retail, office, that kind of thing. And office is one of those things where, from a macro perspective, you hear a lot of negativity and stuff like that. But I always think office is very micro, and I look at office like down the street from my house or something like that that's in a good location with those smaller footprints, like where you could chop them up and all. They're 100% leased. I mean, they have like very little to no vacancy. So what brought you into that market, and then what are you liking about it, and then where do you see it heading, from the tenants that you're seeing and stuff like that? And I'm just curious to hear about kind of the environment there, where you're investing, when it comes to the tenant base and all, but then like zoning too. Like, are you having any issues with any zoning relief needed when you're bringing different types of tenants and that kind of thing?
Yeah. So if you want to get into commercial real estate, you need to get really serious. It's a lot different than apartments. You've got zoning, you've got construction, you've got to build things for your tenants, whereas in apartments, you don't build anything ever. It's a very different business, but I think it's an exciting business because you're dealing with more professional people that aren't going to mentally damage you, and
Sure.
they're going to be respectful, and they're also like bigger deals. Like um, I I signed a lease for $2 million
Mhm.
last quarter, and I really enjoyed doing that as opposed to just doing like little apartment leases. So back to the zoning question, I've messed that up several times. Okay, so I bought a office building in Lansing, in a Lansing Township, Michigan, and the first person wanted to open a hair salon, and I said, let's do it. And then I told them, they had to go get their certificate of occupancy from the township, and the township said your building isn't zoned for that. And they said, but it could be, but you have to put in a new parking lot. You're gonna have to build a dumpster enclosure. You're gonna have to do new lighting, like all this type of stuff.
Yeah.
So I actually had to have that tenant move out um, because they couldn't get their certificate of occupancy.
Mm.
Now it's just considered a straight office building.
Mhm.
So that's why I say I want one story. No, definitely no more than two-story, but I like one story because there's no elevators. I want one story commercial office buildings and flexible zoning so I can rent them to whoever calls. That's what I'm looking for. And so, yeah, you got to stay away from some buildings because of the zoning
Yeah.
issues.
Is that abundant in the areas that you're looking, or is it
Yeah.
hard to find those, or what?
Yeah, I've done enough. Yeah.
And are they same thing, kind of college towns, or
Yeah.
what's that like?
Yeah. Yeah, it is. Yep. Yep. Yep.
Gotcha. What do you think, from an investor's perspective? What would you say to an investor who's looking at multifamily, looking to kind of compare and contrast? I always feel like investors want to compare, commercial, or I mean, we do a lot of SFR and distressed mortgages and things like that, and people will compare it to multifamily or something. And I think you can't necessarily do that. It's like apples and oranges in some cases, but what would you say for somebody who's looking maybe to invest with you, and there's well, you got these apartment deals, you have the commercial stuff. Um, what are the attributes? What are the differences? All that kind of stuff.
Yeah, so it all comes down to who's going to manage it. So I just invested in a real estate syndication that's focusing on senior housing.
Mm.
My partner in some of my other real estate deals is sponsoring that deal, and I asked three questions. I said, how much money do you need? Who's going to manage it? And will I ever have to go there? And he said I need $50,000. We're hiring a expert property manager in that area
Mm.
that has experience on this exact thing, and
Mhm.
you will never have to go there. And I said, boom, sold. Here's
money.
my $50,000. And that's because I trust him as a sponsor, 100%.
Yeah.
Now, is this deal going to be a grand slam? I have no idea, but I trust that he will do the right thing to make sure that the investors are taken care of in the best possible way. So I didn't even, you know, fly to Florida, like tour the building. Like, I didn't do any of that stuff. I just invested in real estate syndication like that. So I'm an LP in that deal. But yeah, so senior housing, I know nothing about senior housing, but I know that we're hiring someone who does. And so that's why I was comfortable investing in it. If you're as a investor going to decide and who's going to, if I want to invest in multifamily or I'm going to invest in commercial, I'm going to invest in senior housing, I'm going to invest in land, industrial. It's all about who's going to manage it, who's going to lease it. And that's really the most important thing. Rather, it's not really the asset type to me that you know, it's not the asset type. It's who's going to manage it.
Yeah, I think that's an extremely it's good insight. At the end of the day, it's something that probably isn't maybe said enough. If you're on LinkedIn, you look at different content and things like that. Everybody's always talking about the numbers and the data and the research and the projections and all that kind of stuff. And that's nice. And there's a place for that. I think there's some balance, right? But at the same time, you hit the nail on the head. Who the person managing it is, whether or not it's going to be successful. And then everything else is somewhat secondary to that. Because if you don't trust the person managing it, but best deal in the world, and they can screw it up. And you read these stories, you hear these stories, you read them. I hear from investors. I just saw something article like earlier in the week. Where people, they took a building that was 95% occupied, and doing well, and in a couple of years it was down to under 85%. I mean, so it's just like the person managing it is extremely important. I think that's good insight and kind of a good reminder to people to don't get so tied up in the numbers and the projections and things like that. You also have to look at the person behind them and who's managing all that kind of stuff. Now, are your deals 506C? Can we speak a little bit about the structure, time frame, returns, that kind of thing, or what's that look like?
Yeah. So they're accredited investors only. We do blind pools where I don't tell you what property I'm going to invest in. I'm going to tell you generally where we're going to invest, what type of deals we're going to do. So my fund will be Class B multifamily in Southeast Michigan, but I'm not going to tell you it's specifically this deal because I don't know which deal it's going to be. That once I've identified the deal, I'll swing back around and tell you what we're investing in. But I'm asking for your money before you know the exact deal. And then we do a 7% preferred return. Over that, it's a split 70-30. There's some deal fees. We're also the property management company, so we have some property management fees. But it's a pretty standard 7% preferred return, 70-30 split.
Gotcha. And time frame, you've 5 to 7 years, 3 to 5. What's that look like?
Yeah, so my fund is set up where it can go indefinitely if we're meeting the preferred return.
Okay.
So if you're not meeting the preferred return, you need to start selling in year 10 and be done selling in year 12. But if you're meeting the preferred return, it can go indefinitely. And investors can always sell their shares. We got a mechanism for that.
Gotcha. And what is the strategy to add value and then continue? And maybe it's not, I don't know with what you're buying on the commercial side. And all, it sounds like everything's there's some value add component to it. It's not just fully stabilized triple net office leases or something like that. But is it? Do you want to hold these properties indefinitely for the cash flow, or and then maybe at some point in the future sell, or what's your philosophy there from a buy and hold to a fix up and sell off perspective?
Yeah, I like the cash out refinances. I don't like selling properties. I don't like dealing with the tax consequences. I find 1031s to be difficult sometimes.
Sure.
We also own the property management companies, so I'm a little biased where I don't want to sell all the stuff I'm managing because we're, we just getting used to it. I don't want to sell it already.
Yeah.
And so it's all value add, whether it's apartments or commercial.
Okay.
So in Beal Fund 1, we bought a 37 unit for $1.3 million. We ran it for 5 years, and then it appraised for $2.6 million. And we did a cash out refinance.
Nice.
We bought in Beal Fund 1, we bought a 20 unit building for $1.3 million. And that was more of a construction project. It was really bad shape. We put probably $200,000-$300,000 into it. So we were into it for like 1.7, but then it appraised for like 2.4, so it's all that value add and then do a cash out refinance.
Okay.
Um,
Is principal is that return to investors, or do you redeploy that, or like what's that look like?
yeah, it's my decision as a sponsor, so I've done it both ways where we've uh, returned it to investors, we've reinvested in other properties within the fund, and then we've also bought additional properties.
Yeah. Yeah.
Yeah, so it's my decision as a sponsor, and that's why I like real estate syndications. Is I'm I truly believe that of this group of investors, I'm the best decision maker of the bunch, and so why do anything else but give me full authority to make those decisions? Um, and if you can always sell your shares,
Mhm.
the fund too. So.
How's that work? Just I'm curious to how you use that as secondary market for selling shares for private investments. So curious to how you're doing that.
Yeah, so there are companies that will do it for you, and there's literally like a company called like Secondary Market Syndications or something.
Yeah. I almost could picture it. I think I know exactly what you're talking about.
Yeah, I forget the exact name, but it's like
Yeah, it's something just like that.
yeah, yeah. So you can do that. You can also, if we're operating on a small scale, you can just handle it. What you do is you ask the person what they want for their share, and then you email the investors and say, "Does anyone want to buy this guy out?"
Yeah.
Um, it gets complicated in situations of what I call dead equity, where uh the 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 value of the share is a lot more than the cash flow that's returning on it at this point because of the value add play. So that can get a little tricky. Um, and then also you can just hire like a law firm or something to do like take you out of the picture and have a law firm handle it for you.
Mm-hmm. So, moving forward, what gets you excited, as we head into the new year here and beyond? Is there anything that has you excited? Like we've been talking about. There's been certain challenges over the last few years with interest rates and rents going up, new supply coming on the market. Just it's been a perfect storm in some ways, especially in the apartment space, and commercial in general. So, what excites you or worries you or anything like that? What are your feelings around next 12 months or so?
Yeah. So last year I was managing a 60 unit Class C building in a small town, and I was also managing a 60 unit building in a high end town that was newly constructed. And on the third of the month, I looked at the rent rolls, and the 60 unit in the high end area that was new construction, 100% of the tenants had paid their rent on the third of the month. Then I looked at the rent roll of the Class C building, and we've been managing this building for 6, 7 years. So we should have had like the best tenants of all time in there.
Sure.
We picked them.
I was gonna say you have no one else to blame, right?
Yeah, right. Less than half of the tenants had paid on the third. And so that's kind of where I want to direct my career is I'm 20 years into this. I'm 20 years into this. Why am I still managing and dealing with people not paying their rent? So I want to focus on Class B that we can turn into Class A. I want to focus on value add office buildings, commercial strip centers, type of thing. I had the state of Michigan as a tenant for 10 years. They paid their rent 7 days early for 10 straight years. So I want to do more of that, and that's what gets me excited. I definitely, you're not going to see me buying a huge value add Class C building in 2025. It's I'm over it. It's just too much mental anguish.
Sure. Well, and I like that you're staying in your sandbox. It sounds like as well. I mean, have you're like the Jesus of investing. It seems like you've stayed in a pretty close range, right? Like you haven't. Have you ever went and dabbled in other areas, or because you've spoken strictly of these parts of Michigan?
Yeah, only yeah. So I am an LP investor in Alabama, Georgia, Florida, North Carolina, South Carolina, in not in anybody's syndication. Like I don't want people listening to this and call me and say I want you to invest in Illinois or whatever. I invest in close partners of mine that I've done Many years of business with, yeah.
Mm-hmm.
Not to say don't contact me. Let's have a conversation. Maybe you got an awesome deal I'll invest in. But I'm just saying, like, I'm not going to invest in every syndication.
Sure.
And so they're just close partners of mine, and they've got boots on the ground in those areas.
Yeah. Yeah. No, that's awesome. I think that's great insight. And for as a passive investor, that's part of what diversification, that kind of thing. And sometimes, it's hard to invest in your backyard depending on where you're at. But so I think that's great insight.
Well, that's the number one thing. People call me and Facebook message me and LinkedIn me from all over the country, and they say, "Oh my God, Stewart, you're an animal. Like, how are you doing? How are you buying 4 properties in a day? And like, how are you doing all this?" I'm like, "Well, look, I live in Ypsilanti, Michigan. There are over 100,000 buildings I can buy for under 200 grand within an hour distance of my house.
Yeah.
So you can't do it. You can't do what I'm doing because you're sitting in Boulder, Colorado right now.
Yeah. Yeah.
And yeah, so I'm blessed to be in a part of the country where deals are a little easier. Now interest rates, of course, have made it much more difficult than usual. But yeah, that we're in deals that if I want to buy a single family house for $95,000, I only have to drive 40 minutes. I can do it Toledo, Ohio, all day.
Yeah. Well, that's great. I mean, taking advantage of the opportunity that's around you and all is great. And I mean, because I see people, I'm from the Philadelphia area where, it was people all over going down to Atlanta and Texas and Arizona, and, you name it, all over the country. And I always just think, like, what is your competitive advantage? When you go into those markets, it's going to take a while. You know what I mean? Like, I could see large companies that have the scale, are well capitalized, being able to get in and have a competitive advantage. But for somebody smaller, like a syndicator or something, that's tough. I mean, you're I don't know how you compete.
Yeah. So yeah, I manage like 100 properties within walking distance of where I'm sitting right now.
Wow.
And so we have an extreme competitive advantage. So next Friday we're buying this like cafe retail building, and we already have the tenant, because we've been in this market for 20 years now. We know the people that want to open cafes. We know the people that are doing things. And so before I even put the building under contract, I called the guy and said, "Hey, I know you've been talking about this for years. I got the perfect spot for you." He's like, "Oh my God, this is great." So, we've got the competitive advantage close by, and my worst deals have been the farthest away from me. So I bought uh, like 1,000 apartments in Akron and Canton, Ohio, which is a 4-hour drive. Okay. And I was in charge of managing. I couldn't manage it. My company couldn't manage it because it's 4 hours away. So I was in charge of hiring the property manager.
Okay.
So how often can you have a serious meeting with someone who's 4 hours away from you? Like once a month. That is probably as often as you could probably do it, right? If you're trying to have a robust business. So we would unfortunately meet just once a month. And this was a little bit before Zoom and blew up and everything. So I'm just like an in-person meeting guy. So like, how often can you meet with someone that's 4 hours away? So the problem is the performance on a property can change so rapidly in 30 days that it was impossible to manage those properties 4 hours away, and they weren't doing a great job. So like you'd meet with them, and occupancy would be 95%, good, and it's 91% next 3 months, and then it's 87, and and so it just deteriorates.
Yeah.
So that's why I like investing close to where I am.
Yeah. That's experience there, and you live and you learn, and then you make decisions moving forward based on that. I think that's so important. Well, Stuart, I could talk to you all day. I mean, this has been a great conversation.
Yeah, we could go 4 hours, I think.
Hopefully, it keeps getting better too. But I want to keep it somewhat short, and I want to leave room for people to call you as well and reach out and learn more about you. So if the audience wants to continue the conversation, learn more about you, learn more about your funds, how do they get in touch with you?
Yeah, so my email is sbeal@gobeal.com, and my 2 websites are at gobeal.com. That's the property management website, and then Beal Capital, which is the syndication website, bealcapital.com. And then I'm Stewart Beal on Facebook. I'm Stewart Beal on LinkedIn, and I check my Facebook messages. My LinkedIn messages come in way too fast, so I have a virtual assistant whose job is to filter through those. But they'll get to me if you've got something interesting to talk about. So.
Awesome. Well, Stewart, thank you so much for being here today. I really enjoyed the conversation. Wish you
Okay.
all the best of luck, and hope to stay in touch and just see where life takes you from here.
All right. Sounds good. Thank you very much.
Thanks, Stewart.
All right. Have a good day.